Should you pay cash or finance that next home? So you've just sold your home in Fairfax, realized great equity, and you're looking to move out to the suburbs, Loudoun County, downsize maybe, and you've got a good amount of equity. It's a competitive market, inventory is low. Your real estate agent tells you that paying cash is going to give you a better shot at winning that offer. What should you do? Well, I had a recent conversation with a long-term real estate broker partner of mine this past week with this exact scenario and talking it through. Yes, a cash offer, while not necessarily the right thing to do from a buyer's perspective, is more attractive to sellers. Should it be? I don't think so. At the end of the day, the seller's going to get their asking price, whether it's a cash offer or a financed offer. But that's the common misconception in the real estate community right now, that cash offers are better. So we looked at it and said, well, if the buyer has the wherewithal to pay cash and is prepared to pay cash, go ahead and write the cash contract. However, at the same time, let the seller know that yes, an appraisal is going to be ordered, and yes, we are pursuing financing, knowing that should something go awry on the financing end, which if the loan had been pre-approved properly, won't happen, that they're prepared to pay cash. Well, why should they do this? This week's total cost analysis is a quick look at the power of leveraging financing the home purchase versus paying all cash. The first column shows a cash purchase, $1 million, obviously no mortgage, no interest rate, payment. Just for comparison purposes, I've got real estate taxes and estimated insurance in here. Total cost to buy the property, including settlement fees and grantor, or not grantors, I'm sorry, but in recordation transfer taxes to the county and state, a little bit over $1 million, $1,000,011. What if that same purchase, $1 million, puts 20% down, $800,000 loan amount, current market rate, good credit, non-conforming jumbo loan, 6 5/8. Yes, we have a payment, a little over $5,000. Cash to close, $221,000 instead of $1 million. And don't forget the tax benefit of having that mortgage. Well, what does that really mean? It means, yes, you're going to have a mortgage payment over the first 36 months, 3 years. The cash scenario is going to save you money, no doubt. Let's look at what's really important for you and your family. Per the Federal Housing Finance Agency, in the last 20 years, since 1991, the average home in the United States appreciated 4.3%. So that $1 million house is going to be worth about $1.5 million after 10 years. So you've had a nice gain in equity, a nice gain in appreciation, $500,000. Fantastic. Net worth, 1.5 million, a little over 1.5. Well, if you financed 80% of that up front, yes, your appreciation is going to be less, or your equity is going to be less because you have the loan balance after 10 years. So you're looking at a little over $840,000 in equity built. However, what if you took that $790,000 up front and invested it? Well, per the Motley Fool, the average return over the last 20 years for the S&P 500 stock, 9.9%. That $790,000 that you were not putting in up front is now worth over $2.1 million. Net worth in 15 years, combined equity and appreciation of investment, over $2.9 million. What makes the most sense? At the end of 10 years, would you rather have a net worth of $1.5 million, or would you rather have a net worth of $2.9 million? You tell me. This is something that real estate professionals and homeowners today need to think about and need to get away from that misconception or myth that paying cash is always best and that mortgage rates where they are too expensive. That is absolutely not true. If you would like a total cost analysis for any specific scenario, just give me a shout. I'd be happy to put it together.